We're here today to discuss the housing crisis and the meltdown of banks, and we'll be discussing matters of economics and high finance, about which I know virtually nothing. I'm a lawyer with a class action firm known as Coughlin Stoya, and I sue banks when they steal money from the American public. It's a growth industry. We're very busy right now. I believe it was Willie Sutton who had the famous line as to why he robbed banks. That's because where the money is, although this week less than last week, it appears. Fortunately, we have a very distinguished panel that does have a good deal of knowledge on matters economic and financial. And I'd like to just briefly introduce them. To my immediate right is Dean Baker, who is the director of the Center for Economic and Policy Research. He has a PhD in economics. He has written many books on the subject. I went through, I won't read all of them. The one that attracted my attention particularly was The Conservative Nanny State, Use the Government to Stay Rich. I'm looking forward to hearing how we do that. Dean appears regularly on network television shows as a pundit on matters economic, and I'm sure his presentation as to how we got into this mess and how we might get out of it will be enlightening. To his immediate, I think I have the, you guys, which order are you speaking in?
Teresa.
You're going second? Sorry. I have the order mixed up. Is Teresa DiMartino. Teresa has gone through this crisis and has successfully come out the other end of it, at least for the time being. I think her journey through that crisis might be the very most enlightening here, and she was able to succeed in not being one of the many, almost million victims of these defaults around the country through the efforts of ACORN, which she will be telling us about. And to her right is Lisa Ransom, who is with the Center for Responsible Lending, which I believe is now oxymoronic. Before taking this position, Lisa spent many years on Capitol Hill working for Gus Hawkins, one of my heroes who we lost recently, and for Maxine Waters. You seem to go with the shrinking violets on Capitol Hill. And she will be telling us a good deal about the predatory lending practices that are at the heart of the housing crisis right now. So before we start, I just actually wanted to share a little story of my own about this. I have a daughter who's now in graduate school. In fact, she's been in graduate school for so many years that I can't quite remember when she started graduate school. But when she was about 6 years old, we had a cat, a little black and white cat named Bonkers. And I walked out on our porch one morning, and there was poor Bonkers hit by a car. And little black and white cat, what was left of him. I buried him by the side of the house, and then I went and woke my daughter up, brought her out in her pajamas, and we sat on the front steps, and we talked about the cycle of life, and she cried, and I cried, and we walked out on the deck, and there was Bonkers. To this day, I have no idea whose cat I buried that morning. But my daughter now continues to believe that I can work miracles. And I think we're going to need a miracle to get out of this economic mess that we're in. So with that introduction, Dean.
I was going to say, given your abilities, I can give you a few people around Washington I'd like you to deal with.
But they may come back.
That's another problem. Let me just correct, the full title was The Conservative Nanny State, How the Wealthy Use the Government to Stay Rich and Get Richer. But anyhow, so what I want to do, if I could find the right place to start here. We'll see if we could work this out. Okay. Okay. Oh, there's the one I couldn't bring up before.
Right. Don't lose it.
We won't lose it. Okay. Okay. We hate Bill Gates. Ah, there we go. Okay. Yeah.
How many times did you do that?
Okay, this is. Don't do that.
It's just like dating in high school. Do that, don't do that. Don't touch that. No, do not touch that.
Chris, I think he needs a little help.
Okay. You show. All right, I knew that could be done. Okay, now you aren't going to trust anything I say. Okay, the basic points I want to say is, first off, the collapse of the bubble was predictable and predicted. Second, it was easy to predict because there was an unprecedented run-up in house prices. I'm going to say that it was inevitable. It was going to collapse. It was going to end very badly. And lastly, that as we talk about policies, we don't want to bail out the bankers. Just a couple quick points. I'll go through this in a little more detail in a second. But it's absolutely infuriating to me as we see this crisis that we still have all these people running around saying, who could have seen this? You know, how could you have envisioned this? And I'm serious. I'm deadly serious. I was at a meeting at Brookings, a lot of very prominent people you might have heard of, like our former Secretary of the Treasury, Larry Summers, and another former Secretary of the Treasury, Robert Rubin. And Robert Rubin actually began the session. He had introductory comments, and he said, few, if any, people could have anticipated this sort of, financial carnage. And, at which point I kind of wanted to strangle him. I go, no, people did anticipate it. You didn't listen to us. You made lots of money, but you didn't listen to us. And then they're sitting around going, and I swear, Robert Rubin said the government had to intervene. They have to intervene. This is a real crisis, which brings me back to why I want to get the title of my book right, The Conservative Nanny State, How the Wealthy Use the Government to Stay Rich and Get Richer, because that's exactly what's going on right now. They blew it. They created an absolute disaster. We're going to have an awful lot of people pay a really big price for it. But what do? They want the government to come in and bail them out. That's the basic story here. And let's hope we don't have that happen. Okay, housing bubble was easy to see. This is a long list of my reports, which I'm not going to go through. But you can see I have a whole pile of reports dating back to 2002. We were doing everything we could to say there's a housing bubble. We actually had an essay contest. We had an essay contest where we promised a $1,000 prize that my center's a small place. We didn't have the $1,000 at the time. But we had an essay contest, the best essay saying why we don't have a housing bubble. Interestingly, someone from the Federal Reserve Board won it. It wasn't a very good essay, but it was better than any others we got in. And the part we liked about was we got written up in the New York Times, so we at least got a little attention for that. But the point was, we've been talking about this. It wasn't, myself alone. There were others, but it was easy to see that there was a housing bubble. How could we see it? Real house price index. This is government data going back to the early 50s, and what we're doing here is tracking house prices against inflation. And what you see is that house prices generally pretty much follow the rate of inflation. They don't have a tendency to rise more rapidly than the rate of inflation. I have this data going back to the early 50s. Robert Shiller, who many of you have heard of, a very good finance economist at Yale University, wrote the book, The Irrational Exuberance, about the stock bubble, and he has round two where he talks about the housing bubble. He went back and constructed his own series dating back to 1895. And he finds for 100 years, 1895 to 1995, house prices just track the rate of inflation. Then what happens? Well, in the mid-90s, interestingly, coinciding with the stock bubble, house prices suddenly take off. Okay, so that sort of might be a little indicator you have something unusual going on. You have house prices for, in my case, we had, over 40 years of data. In Shiller's case, 100 years of data where it just tracks inflation. Suddenly house prices start to go through the roof. Happens to coincide with the stock bubble. There's a country called Japan where this happened in the 80s. We might think that you're seeing the same thing here. Okay, well, I first began looking at this because back in 2002, I heard Alan Greenspan give testimony saying that we had no we had no house bubble. And what did he say? Well, he gave reasons as to why house prices were rising. And none of them made any sense. Okay, we look at the fundamentals in the housing market. So I was listening to Alan Greenspan, and he said, well, population growth. And I was kind of scratching my head on that because I've done a lot of work when I'm not working on the housing bubble, done a lot of work on Social Security. And the story of Social Security is supposed to be that we have slower population growth. So you're sort of wondering, why are we worried about having slower population growth over here? And then Alan Greenspan saying house prices are going through the roof because of rapid population growth. Well, that doesn't make any sense, and it doesn't make sense. We have actually had much slower population growth, slower rates of household formation, whatever variable you want to look at. It was much slower in the 90s and this current decade than it was in the 70s and 80s, back when troublesome baby boomers were first forming our own households. That made no sense. Okay, step 2 on the demand side, income growth. So Greenspan was saying, well, we've had very rapid income growth. Well, this is 2002. You go, well, actually, we're already in a recession. We haven't had good income growth 2002, 2001. We had good income growth in the late 90s. But on the other hand, we had good income growth in a quarter century from 1947 to 1973, and there was no uptick in house prices. So that one doesn't make any sense. So there's not a demand side story. We had slower population growth, relatively slow income growth. There's no reason to expect on the demand side that we'd be seeing any sort of housing bubble. Secondly, he goes, well, supply side. Well, one of the things he said was there's a limited amount of buildable land near cities. And you go, yeah, that was true before 1995. So what was it about 1995? Suddenly it led to a big increase in house prices. Plus, we were just over the internet bubble, and the people in the internet bubble were saying things like space and time don't matter anymore. That was nonsense. But on the other hand, there is at least a grain of truth in that many of us were in jobs where we could be living almost anywhere and sending our stuff in by computer. I recognize that's a small minority, but no one could be doing that 20 years ago. So to at least some extent, insofar as there's space constraints like that, we might think they were less binding, in 2002 than they'd been, say, 10, 20, 30 years earlier when we didn't have a bubble. The other thing he said was environmental restrictions on building. I'm going, this is the heyday of environmentalism. Republicans just took over Congress. They took over state house. I mean, that was kind of nutty, And of course, if you really, cared, you go, well, let's just look at the construction numbers. And, 2002, we had construction going through the roof. And, 2002 through 2006, we had near record rates of housing construction. So obviously, supply was not a restriction. So long and short, if you look at the fundamentals in the housing market, there was nothing going on the demand side, nothing going on the supply side. It didn't make sense that the bubble was being driven by fundamentals. Okay, well, last thing you look at, the rental index. Okay, there's basically one housing market. I realize, most people aren't going to sell their house and become a renter tomorrow if, the rent goes down, but there are always people, they move to a city, or people forming their own household for the first time. They make the choice, are they going to own or rent? And to some extent, there is a trade-off. So if there's some fundamentals driving up, housing prices, we'd expect something to be going on the rental side. And you look at it, nothing's going on. Okay, rents increased a little more rapidly than inflation, but it's no big deal. There's no bubble in the rental market. There's no prices going through the roof. And last few years, rents have actually been falling a little bit in real terms. So it was easy to see, and I went around with a lot of economists and argued about this and said, look, there is no bubble. There is no basis for the bubble. There's no fundamentals. But, the big problem was, that you had most economics profession that were anxious to celebrate this. And of course, the media talked to those people. And you may have heard of the person who's the most prominent figure quoted on the housing bubble was David Lira, who happened to be the author of this book, Are You Missing the Real Estate Boom? He was the most widely cited expert on the housing market, so most people, that was all they ever heard. Housing prices are just going to keep going up and up and up. Okay, well, that doesn't happen. We saw house prices began to fall, and in fact are falling quite rapidly now. The latest data we have, house prices are falling at about a 10% annual rate. So what does that mean? Well, it means that we're going to lose on the order of $8 trillion of housing bubble wealth. That's at least if the bubble deflates fully. I don't have a crystal ball that tells me that it will deflate fully. It might not. It might deflate. We might overshoot. Okay, we might lose more than $8 trillion. What does $8 trillion mean? Well, it's $110,000 for every homeowner in the country. Okay, it's real money. Again, thinking back to the Social Security debate, it's kind of infuriating because, Social Security debate, we had these big arguments about, somewhere in 2050 we might have to raise Social Security taxes, 1 or 2 percentage points. Well, here we are sitting on an $8 trillion housing bubble. You've got millions of people, many of whom are, just at the edge of retirement, who thought they had $200,000 in equity in their home. Now they find out they have $100,000. Some are going to find out they have zero. In some places, house prices are going to fall 30 or 40%. In some places, they already have. Okay, so this is a really big deal. We are in a recession. There's no longer any doubt about that. Really, the only question is how big and how deep a recession and how long it lasts. But I don't think there's really any doubt. I shouldn't say I don't think. There is no doubt at this point that we are in a recession, and it is going to get worse. The big question is, the other big question is, what happens with the banks, with the housing market going forward. And to date, I'm very concerned as to whether we end up bailing out the people who got us into this mess. To my view, the public has an interest in maintaining an orderly financial system. We don't want to see the financial system freeze up and people unable to get loans, or people unable to get deposits out of their banks because the bank is closed. But at the same time, we have no interest in giving taxpayer dollars to the people who gave us this mess. And I think we're skirting a very fine line. I wrote this before the takeover of Bear Stearns by J.P. Morgan, but what happened there was, on the one hand, the shareholders of Bear Stearns did lose their shirts. Basically, they got something, but not very much. They lost about 90% of their stock value, which is certainly appropriate. But what I worry about is whether we gave J.P. Morgan a freebie, that we gave them, in effect, we guaranteed $30 billion of Bear Stearns assets, and I worry that, in effect, we gave J.P. Morgan an opportunity to bet with taxpayer dollars, that if things go well, they end up making lots of money. If things go poorly, we end up with the bill. That's not a good policy. The example I've been trotting out here is Northern Rock, which was a big bank in England that found itself in trouble because they also were speculating in the U.S. mortgage market, and it turned out they went belly up, and what the British government did was they basically took over the bank, and they kept it operating, so people could still, go down to the bank, get their money out, put money in, whatever it might be. But what they said was the shareholders are out of luck, and they threw the management, the people that put the bank into bankruptcy, they threw them out on the street. And I would like to see that be our model going forward as to how we deal with the banks. Glad we don't have any disagreements on that. Let me just say another quick thing on terms of the bailouts, because banks, one of the things I say about the bankers, this is really true of all these people in D.C., they always take hostages. And the hostages that the banks are going to try and take here are the low and moderate income homeowners, the people that they ripped off with predatory mortgages. And they're going to have bailout plans. I shouldn't say going to. They have bailout plans that are basically bailout plans for the banks. It's really important to keep your eye on the ball, follow the money. When you're talking about a bail plan, who gets the check? Most of the plans that I see out there talk about having the mortgage holders get the check. They have the banks get the check on a mortgage that has lost most of its value because the person can't pay it. That's not something I want to see. I want to help out the homeowners. I'm not interested in helping out the bankers, helping out people who made bad investments. If they didn't know what they were doing, well, that's kind of the way the market works. What I've proposed, I won't go into detail here, though, as an alternative, is if you gave people who are facing foreclosures, the people who are in these bad loans, if you gave them the opportunity to stay in their home as a renter paying the fair market rent. The judge just brings in an appraiser, you have a foreclosure process. In the process, the judge brings in an appraiser, determines what this place would rent for based on comparable rents, just like an appraiser does when you buy a house, they look at comparable sales price. They give the person the option to rent at the fair market rent. Well, that does two things. One, it gives that person some security. More importantly, it's a safe bet. No bank wants to be a landlord. Okay, so what does that mean if they know they can't just have a foreclosure and throw the homeowner on the street? What it means is they have a really strong incentive to renegotiate the mortgage and find terms that keeps the homeowner in the house as a homeowner. Okay, so that's the line, at least at which I would think about this. How can we help out the homeowners and really not look to give the banks anything? We don't owe them anything. If they're in trouble now, it's their own bad judgment. Okay, so just a couple concluding points, what we should know and do. I think we should run to town on the fact that the neoliberal experts, the people who were supposedly, the Wall Street wizards, both economists and the finance people, they didn't know what they were doing. I'll confess, I'm not an expert on finance. They develop more complex instruments than I can keep track of. I've been learning about them as, they appear in the paper in some cases. It turns out the people who were inventing them didn't know what they were doing either. It's really incredible. And the point I keep making on this, and what just infuriates me is, you talk, we have big arguments. We think workers should have job security. We think that's a good thing. Well, imagine an ordinary worker, a custodian, someone who washes dishes, someone who drives a truck. Suppose they had wrecked the truck. They get fired. These people wrecked the truck in a really big way. And they think they should just walk away, Who could have known? Who could have known? Well, they really have to be held accountable. They were supposed to know. If they didn't know, that's really ungodly negligence. The price, this is just enormous damage. I mean, I'm reluctant to tell jokes in this context because, this is really unbelievable. For the vast majority of people in this country, their major financial asset is their house. We have data on this. They don't have, $300,000 sitting in a retirement account. I realize some people are lucky enough to be in that boat. That's a small minority. Most people don't have a defined benefit pension. That's history. I think defined benefit pensions are great, but the fact is the vast majority of people don't have them. So what do they have? Well, the vast majority of people in the country, the only thing they had was some equity in their home. And for the vast majority of people in the country, they just lost it. Okay, that was really, really incredible. And they lost it. We could say, well, they should have known, but the fact of the matter was they're being misled by, people like my friend David Leroy, who's the chief economist of the National Association of Realtors. I should have also pointed that out.
Coincidence.
He has a stake in this game, and they ended up making some really, really bad choices, which they're going to pay a huge price for. And, the last thing on earth we want to do is, reward these people with a taxpayer bailout. These are the folks that, these are the richest people in the country. You're talking about people who make hundreds of millions a year. They have their, mansions on the Hamptons. They have vacation homes on islands. They have private jets. They have servants. The rest of the year, this is one of the things that I'm sort of amazed. There aren't more people yelling and screaming about this. The rest of the year, we're begging Congress to, just restore their taxes back to the Clinton-era tax rates. So, if we, and they say that would just be devastating to the economy if we paid them pay the same taxes they did, 10 years ago. Well, I'd love to see them restore taxes to the Clinton-era tax rates. I'd love to see them raised much higher. But let's just start with something very, very simple. Let's not give them taxpayer money, and that's where we're at right now. Okay, so I think that's my last slide. Yes. Okay, so I'll stop with that. No taxpayer money for the Wall Street folks.
You're here.
Hi, my name is Teresa DiMartino, and I'm a proud member of ACORN from Burien, Washington. I work for King County Public Health, where I've been employed for the past 17 years. I'd like to thank the organizers of Take Back America conference for putting this event together and for allowing me to speak.
Listen, I want to speak up just a little.
Sure. ACORN did it. I qualified for a loan workout program with Countrywide ACORN agreement. My 8.99% interest rate ARM that would have caused me to lose my home will change to a lower fixed 30-year rate. Thank goodness. It was my first house I've ever owned, and when I bought the house in 2003, I had no idea that I might someday be facing foreclosure. But when my Countrywide subprime adjustable rate mortgage went from $1,442 to $2,390, I could no longer keep up my payments. And like a lot of ACORN members, I was facing foreclosure as a single mother. My 6-year-old son's father left our home in October of '07. Because I could not afford to make my mortgage payments, I destroyed my credit rating. I had many sleepless nights, months of depression, and stress was just unbearable. I was forced to put my home up for sale, but I had no offers. I felt I had no control over my life. But because of ACORN, I have a chance to get out of this mess. I'm the first person in Washington to get assistance from ACORN's help program and qualify. Now, some of you might ask, how did ACORN get to a point where we have success stories like mine? They have lobbied, marched, researched, educated, raised our voices, and negotiated and won. What's going on here? What is the problem? Predatory lending has led to an epidemic of foreclosures. In 2006, there were 1.2 million foreclosure filings, over 2 foreclosures every minute, a large increase from the 900 that were filed in 2005. This year, the problem is expected to get worse, with over 2 million foreclosure filings. One main reason for the increase in foreclosures is the huge growth in subprime loans, which have higher rates and fees and harmful terms, like prepayment penalties. Subprime loans are intended for people who can't get prime loan at a good rate, but Fannie Mae and Freddie Mac have estimated that between a third and a half of all borrowers in subprime loans could have qualified for a better loan. Over 3/4 of all subprime loans are adjustable rate mortgages, in which after 2 years the rates start to increase and quickly becomes unaffordable. Many borrowers were steered into these ARMs without being given a choice and weren't told how ARMs work or the risk that they pose, which is what happened to me. It is estimated that $1 trillion in ARMs will have their interest rates increase this year. Foreclosures, excuse me, not only harm individual families, but also entire neighborhoods due to the increase in vacant houses and the decrease in property value. ACORN's campaign, ACORN members have been fighting predatory lending since 1999 through outreach and education to help homeowners avoid becoming victims of predatory lending and getting regulators to crack down on the worst companies. In addition, ACORN members have gotten laws passed in 7 states to protect families from predatory practices. Washington State will be number 8. This year in Olympia, Washington, ACORN had some great successes in our state legislature. There were 6 bills introduced this session dealing with the mortgage crisis. Thanks to ACORN's hard work, nearly all have passed and are on their way to being signed by the governor. The bill considered the most helpful to ACORN members is the bill that sets aside $1.5 million for mortgage counseling. Educating people about the mortgage process is going to go a long way in preventing the sorts of problems that have caused so many people to lose their homes. And I, to my dismay, am a great example of this. There were 2 bills passed that covered many aspects of mortgage issues. Both were drafted directly from proposals submitted by the governor with ACORN members' input. These bills will regulate the mortgage industry by encouraging responsible lending, protecting the borrower, and helping families stay in their homes. Another important bill that was passed this session establishes a fiduciary responsibility of the mortgage broker to the borrower. Up until now, the mortgage broker was not required to work in the borrower's best interest. I wish this bill was in place when I got my mortgage. ACORN members and myself made the hour-and-a-half trek to Olympia to make sure we could have this important protection. We met with the governor's top staff to the sponsors of our bills, and we won. This makes Washington State number 8, just 42 more to go. How are we going to get the rest of the 42 states with the programs? ACORN members will do what they do best. Outreach into the communities. We plan on talking to over 2 million voters in the states that have been hit the hardest by foreclosures: Arizona, Ohio, Michigan, Nevada, and Florida. ACORN members want people to know they have options, not only when you might lose your home, but in the future of our country. Thank you.
We're going to see if this works,
Here
and
we
if it
go
doesn't,
again.
we'll work around it.
We will find it.
There's a way, there's a way.
13.
And when I want to, okay, and when I want to move this program forward.
Just get this done.
Good afternoon, everybody. You know, Dean did such a great job in doing an overview of what was going on that I'm going to give some attention to some of the legislation that's being addressed on the federal level. So I'm going to kind of skip through some of this. Oh, to go back and say, Center for Responsible Lending is a nonprofit, nonpartisan research and policy organization. We are also affiliated with Self-Help, which is one of the largest CDFIs in the country.
What's a CDFI?
Community Development Financial Institution. We are one of the largest nonprofit credit unions in the country. I'm going to kind of focus on the federal legislation because Dean did cover the subprime data, although I'm going to raise a couple of things. And I want to focus on the overall subprime problem, but I think everybody in here knows what the problem is, and we need to give some attention to some action steps. So let's kind of get through this. I do want to stop at this slide because it talks about where we are with subprime resets and what we see as the peak coming up, or we're in the middle of the peak for subprime. But what I want folks to pay attention to is, while we're looking at subprime, don't forget Alt-A, payment option arms, and interest-only loans, because we see this going into the next 5 to 7 years. This is not a problem that's going to disappear in the next year. We're going to have this for a while, and we need to figure out the quickest way to address this problem, short-term and long-term. With HMDA data, the 2005 HMDA data among subprime loans that were given for people that qualify for prime, 52% of subprime loans went to African Americans in comparison to 40% that went to Latino Americans and 19% that went to white Americans. And all these folks qualify for prime. A lot of subprime facts, but the things that I want us to remember here: 1 in 5 subprime loans will end in the loss of a home. Critical point. 70% of them lacked escrows, which meant when you got that surprise tax bill at the end of the year and you weren't sure where you were going to get the money to pay that bill, the likelihood of people going back to their mortgage broker saying, I need some help, only to be refinanced into another predatory loan was great. And with that refinance probably came a prepayment penalty, anywhere between $3,000 and $10,000. What's also very important to remember here is 10% of the loans made in 2006 went to first-time home buyers. So where did the other 80–90% go? To refis. And this is important to know and understand, because if you own a home, if you purchased a home, you probably think that you know how to refinance a home because you don't view it as a purchase. This is a financial transaction that you've done before. The only difference is the product that you're dealing with now is not the product you dealt with 10 years ago or 15 years ago. So a lot of people, Gesundheit, for lack of a better term, were bamboozled. Yeah, I said that. The spillover rate, and I really want to address the impact to communities here. A lot of people who have looked at foreclosure thought, that is someone else's problem if I'm paying my mortgage. Well, let me tell you, you can be paying your mortgage on time without any fault, but if you have 2 to 3 homes in your neighborhood, in your block, that are suffering from foreclosure, each home can devalue your property by $3,000 to $5,000. So this is the low end of that. So if you have 3 homes on your block that are in foreclosure, your property value went down by $9,000. What does that mean? Not only did your property value go down, but the tax revenue from the foreclosure has then impacted the tax revenue collected by the municipality and the state. What does that mean? It means the revenue that goes into the municipalities that pay for our school systems, transportation, public safety, sanitation, their budgets just got cut. So if you didn't think that it impacted you directly, I'm sad to tell you that it impacts all of us directly. Now, out of the 100% of the borrowers out here that are in subprime, we can probably refi 40% of them through Fannie Mae, Freddie Mac, and FHA. 20% we can modify through loan modifications, and we're going to talk about that legislation in a second, based on their initial interest rate, and they're 228 or 327. For those folks that have some negative equity and their loans are upside down, the current legislation being considered could probably address the negative equity issue, and 20%, the 10% speculators, and there are some borrowers that we can't help. We know we can't help everyone. But I think if we can help 80% of people in this situation, that would be a significant first step. Solutions. Now, before I start talking about solutions, there's a number I want you to remember, and it's 20,000. And I'm going to talk about 20,000, and I want you to think about this number because it's associated with a shelf life. Right now, there's legislation being considered that we need that could amend the bankruptcy code. And I think we need to get past the stigma of the word bankruptcy and help people get past that word, because at the end of the day, this is really about helping people save their homes. That's the goal. That's the bottom line goal. Currently, Chapter 13 in the bankruptcy code allows you to have a loan modification on a second house, a boat, a farm, everything and anything except your primary residence. That's what the current legislation is trying to address right now. Now, the issue of automated loan modifications, well, we're seeing 1% of the lenders and the servicers actually modifying loans. And under the administration's plan, we would see approximately 3%. Both of those are unacceptable. And there's a reason why we're seeing the servicers not modifying the loans, and we don't really talk about that. Frequently, you go to congressional hearings and you hear the bank say, call the lender. How many times have we heard, just call your lender when you're in trouble? Well, first of all, 9 times out of 10, a lender is not holding your loan. A servicing company is holding your loan. And they're not necessarily responsive because they have no incentive to modify the loan. The way their contracts are written to collect payment, they receive no compensation for loan modification. They do receive modest compensation for foreclosure. There is also the issue that approximately 70% of the mortgages have seconds, piggyback loans. And the problem here becomes a liability issue because if the servicer attempts to modify the loan, one of the lenders, probably the second, the smaller loan, is going to be written off. They gain no compensation by doing that, and so the servicer has to deal with the possibility of being sued by the second lender. So there is no incentive whatsoever for them to modify the loan. Here's some incentive. Right now, there are 3 bills, 1 in the House, 2 in the Senate, and there are a couple of bills going on with predatory lending, but these are the bankruptcy reform bills. The House bill currently is H.R. 3609. It was introduced last fall. It has 81 co-sponsors. It has support of Congressional Black Caucus, Congressional Hispanic Caucus, some Blue Dogs, and it is bipartisan. We need 131 other co-sponsors and supporters to get this bill through the House on the floor. It has already come up through the House Judiciary Committee and been marked up. It just needs to go to the floor. On the Senate side, this is where it gets interesting. The Senate bill 2136, introduced by Senator Dick Durbin, has 13 co-sponsors. It's been sitting in the Senate Judiciary Committee for markup. It was supposed to be marked up last week. It was supposed to be marked up 2 weeks ago. It was supposed to be marked up 3 weeks ago, and it's currently on the calendar, but it's not moving, and now they're in recess. When they come back, the bill that we will see addressed is going to be S 2636. That was introduced by Senate Majority Leader Harry Reid. The reason this bill is so important is because it's a housing stimulus package that includes S 2136 under a Title IV provision. 2636 will go to the Senate floor the first week of April. It's scheduled to go to the Senate floor the first week of April. However, it only has 25 co-sponsors. And nothing on the Senate side is bipartisan. So we need your help. We need you to be vocal and verbal, and we need you to contact your senators, and that 20,000. 20,000 homes are lost to foreclosure every week in America. 20,000. And why this is important is because this legislation has a shelf life. We can pass it, but if we wait to the end of the year to pass it, how many homes have we lost in the process? So keep that number in your head when you're talking to your senators in both parties about their need to move this legislation forward when they get back from recess. Closing comment. House Financial Services Chairman Barney Frank has introduced a draft proposal. It's not yet legislation, but it is a draft proposal. The idea is to be able to find funding for FHA, to be able to purchase existing loans that are about to reset and allow them to be restructured and backed by government funds to be sold to FHA-approved lenders at a 30-year fixed rate. If we are able to do this, we can save 1 to 2 million families from foreclosure. Now, you couple that with the number that we could save in bankruptcy reform, which is roughly 600,000, if we act in this window of opportunity between April and June, we might actually be able to help people stay in their homes. There are a couple of other pieces of legislation I just want to remind you of. On the Senate side, Senator Dodd has introduced a companion bill to what is passed out of the House. The House bill is H.R. 3915. That was introduced by Barney Frank, Mel Watt, and Brad Miller. That bill has passed the House. We're now waiting for Chairman Dodd's bill, which is 2452. It needs support as well because it's more of a preventive measure. But if we want to save people now, we want to support Chairman Frank's FHA package, and we want to support the Senate bankruptcy reform bills. I thank you for your time, and I hope that you have the energy to knock on your Senate doors while you're here.
I think we're going to have questions now. I just wanted to make just a brief comment about these presentations, and it's a little different perspective. It's from the perspective of deregulation. And that looking at this debacle right now in the context of the series of debacles that have characterized American markets, at least since the early 1990s and the Clinton administration in particular. And it was during the Clinton administration that the Congress, with the acquiescence of Clinton, even with the encouragement of Rubin and Alan Greenspan, repealed the Glass-Steagall Act, which said it was a Depression-era statute that said that banks should be banks, and they shouldn't be anything but banks. It was also during that administration that Congress, over Clinton's veto, enacted the PSLRA, which made it much easier to commit securities fraud and tried to put securities lawyers, including especially my law firm, out of business.
Can you tell us what PSLRA stands for?
The Private Securities Law Reform Act, which made it much harder to prosecute fraud cases. Right around the year 2000, when Enron broke, people don't realize how much these very same banks were in the middle of the whole Enron mess. And so far, we've collected over $7 billion from banks that were in cahoots with Enron and committing that fraud. When the tech bubble burst, and we had the charitably called economic downturn, that's when the Fed started dramatically lowering interest rates, and at least was one of the reasons why we had this. We went from one bubble to another bubble, the housing bubble, which fueled the stock market. And we recovered, if you will, from the tech bubble bursting by simply blowing another bubble in the housing market. Now those same banks and the same kinds of shenanigans in Wall Street have resulted in the housing bubble bursting. And I guess the question I have for the panel is there another bubble? Or are we really going to follow in what occurred in Japan not that long ago, where we did not have a slight economic downturn. It was handled with a stimulus package, and we all went back to frying our hot dogs. Instead, you had a serious economic, systemic problems that took many years to address. So I'd like to start with that question.
Okay, I sure hope there's not another bubble. You know, I often talked about Greenspan seizing on the housing bubble, and I always use the analogy, it's like the alcoholic whose way of dealing with one hangover is he starts on the next. And that's basically what we saw, because it was bubbles burst. I mean, that's not a way for an economy to grow. We didn't have bubbles driving the economy in the 50s and 60s and the 70s when we had balanced growth, where we had wages driving consumption, which drove investment, which then led to higher productivity growth, higher wage growth. That's the sort of economy we want. We haven't seen that for the last quarter century. Instead, we've seen this bubble-driven growth, and it's not a good story. Bubbles end badly. So I sure hope we don't have another bubble out there. Now, what that means, though, is the adjustment process is likely to be very long and painful. One really big part of the story is something a lot of people say is bad. The dollar falling. We should celebrate that. That is a really good thing. It hurts. It means we pay more for imports. But that's the only way we're going to get our manufacturing sector back on its feet. We have to have the dollar fall. That will make our goods more competitive. That is like 1,000 times more important than NAFTA and all the other trade agreements, which I think are important. But, you know, if you give me the choice of, you know, getting rid of all the bad trade agreements or getting the dollar down by 20%, that takes me half a second. Get the dollar down by 20%. So we are in for a bad period, but, you know, part of the way of getting things better, getting things right, is having the dollar fall, getting our manufacturing back on track, getting down our trade balance. But there's no two ways around it. It's not going to be pretty.
Questions? I guess you use the mic is what they...
Dean, I have a question for you. There's a debate going on about whether there's a way to keep this from fully deflating. I mean, whether it's possible and whether it's good. You know, there are charts that show, well, let's say housing is on average $100,000, you know, overinflated. How far do you think it's going to fall?
Okay, well, first off, yeah, there is this debate on this, and I have to say, I really am disgusted by the economics profession because they're just so dishonest. You have, you know, the profession loves to, you know, you're an idiot in economics if you don't support the trade agreements, you know, NAFTA, CAFTA, you're just an idiot. You should have to support free trade, which they define as those trade agreements, which they're not, but, you know, you're an idiot if you don't support that. Well, many of the biggest free traders, and I'll mention one guy who I actually think is a very good economist and actually a decent person, but on this he's absolutely wrong. Alan Blinder has come out with what I call the house price support program. He wants the government to, in effect, try to keep house prices up. Now, what I say is I cannot think of any reason in the world we want more people to buy houses at bubble-inflated prices. That sounds really stupid to me. You know, a lot of people will be struggling. That's one reason why people took out really bad loans. That was the only way they could afford houses at bubble-inflated prices. I don't see that makes sense. The other part of the story, a lot of people were sitting in their homes thinking they had equity. Why not borrow against it? Why not take a vacation? You know, why not, you know, the price will just keep going up. That's what my buddy David Lira said, you know. So I don't see that we have any interest at all in keeping prices up. You know, that's, I have to say I'm not a supporter of the Frank bill because I think that has that effect, or it can have that effect. But it would only be short term. It can't do it for too long for the same reason that, you know, they tell us that farm price support programs are really foolish. You know, unless we prohibit people from building new homes, if you keep house prices up, you'll get more homes, you'll get more supply. That will eventually press house prices down. So I would really just as soon see house prices, you know, adjust to their trend level as quickly as possible. Now, you asked me how far that is. Nationwide, the average house price, as I say, rose about 70% in real terms, you know, over this period, over the decade. It's fallen now about 13-14% in real terms. You have about another 15 to 20% drop, I would say. Now, there's huge differences in some of the most overvalued markets, you know, Miami, San Diego, Los Angeles. You might have another 20%, even 25% drop in some of those places. So we have, I think, a significant way yet to go. So it's really going to be an awful process, and I don't see any way around it. I just as soon see us get over with it as quickly as possible so we could start to try and get the economy back on a sound footing.
My name is Eddie Eiches, and I'm president of the union that represents HUD employees. And I have a whole slew of other suggestions. First of all, FHA modernization. As you might know, that the legislation that passed only temporarily increases the FHA loan limits, and whatever one says about FHA wasn't the subprime crisis. Many people could not get FHA loans because the limit was so low that basically the whole East Coast and the whole West Coast and portions of mid-America like Chicago, the FHA loans were at such a low level, that that if you bought a house, you couldn't get an FHA loan. I think that's really important. Both houses have proposed legislation to do this, and we really need to get it passed because by December that will end. I think also, as you've said, we need to put more money into housing counseling. There have been proposals by Senator Dodd to increase it dramatically. Those who went through housing counseling, I think 93% are still in their homes. I mean, the foreclosure crisis, subprime housing counseling. So it's housing counseling is really incredible. We need to do more to fund that. We also need to do more in rental housing. We need to push Congress and push this administration, which wants to cut housing, 202 housing for the elderly and housing for those with disabilities, 811 housing. They want to cut that now, and we need to preserve rental housing and increase that. I think that's really important. And finally, we need to do a lot more with community development block grants, which this administration also wants to cut, because community development block grants absolutely can help people in all types of ways to at least deal with this recession.
Did you have a specific question you wanted, or just a reaction to that?
I guess Lisa can comment on it.
I just have a comment about housing counseling. I'm a big supporter of housing counseling, but I do think it should be HUD-certified counseling, and I think that there needs to be some emphasis on post-purchase counseling, because when we hear housing counseling, we usually think of first-time home buyers. We don't think of refinancing. And since we know a large percentage of people in subprime predatory loans are there because of refinancing, there needs to be a requirement that speaks to counseling prior to being able to refinance a home. And we're not talking about an hour before you go to the settlement table.
Eleanor?
Yeah, hi, I'm Eleanor LeCain. I live here in Washington, D.C. I want to thank you all for this fabulous panel. I have kind of a three-part question for Dean Baker, whom I greatly admire, and you restored the name of The Economist.
Are there any subparts to those, or are there just three?
Yeah, they're really subparts of one big question.
Okay.
One is just straight fact. You mentioned about housing values dropping 30 to 40%. I assume you mean from the high, and I'm wondering how long you think it'll take us to drop. I know some places have already, but just kind of over what time frame. Second part of the question is, we know that given the decline in income for Americans over the past 30 years, they've been making up for it by using our houses as ATM machines. Now with that $8 trillion in value dropped out, Americans have lost that economic buffer. And there's some discussion about the next shoe to drop is going to be now with the credit cards, because people are now using credit cards to buy groceries and to live off of. So I'm wondering what you know, if anything, about kind of the next shoe to drop with the credit card exposure that most Americans now have. And finally, I'm intrigued by your suggestion about nationalizing the banks. I am outraged that these people in Wall Street have engaged in this reckless so-called investments in trading. They've made hundreds of millions and billions of dollars off of it, and they've cashed out their money, including, Bear Stearns, these guys who, sold when the stock was 100 or 70, and now we have U.S.-backed, J.P. Morgan, where J.P. Morgan gets the benefit if it succeeds, and the taxpayers have to pay if it's a failure. And repeatedly, we've seen the problem where the profits are privatized and the losses are socialized. The profits go into private pockets, but the failures are picked up by the American taxpayers. Now, it seems to me, I love your idea, if we can nationalize the bank, if we're paying the bill, we might as well have the chance when the sun shines to make some money here for the American taxpayers. So I love your idea. What's the level of support for it now? Where are the current...
It's in this room, I
It's
believe.
in this room. We build from one onward. There's hope.
We have 100 votes, that's it.
has this been raised at all with the Democratic candidates? And I want to support you or whoever is working on this.
It's called risk-free banking.
Well, I'll start with the last one first. It actually shouldn't sound that radical because we have sort of done this already. I mean, back in the early 80s, there was a major bank, the Continental Bank in Illinois, that got itself in big trouble on some bad real estate deals, and they basically went under, and they were taken over. The idea was you keep it operating. It was taken over, so people who have deposits there didn't have to worry that they couldn't get to their money. And it was eventually, broken up, sold off. I don't know if the government ended up making any money on the deal or not, but in any case, the point was it was taken over for a period of time, and then eventually it was sold off, shut down. We can, I think it's not impossible to envision that happening, just because the deals that they crafted, they had real trouble getting, that Bear Stearns deal crafted. I mean, if there's public attention brought to this, I think you can force them to do it, because that really is what they are supposed to do. I mean, that is, the Fed is really, Bernanke's out there really going very much ad hoc and probably exceeding his legal authority. I'm not the lawyer here, but probably exceeding his legal authority in many of the, the arrangements he's making. So to a large extent, this is just the law as written. If a bank is bankrupt, it's supposed to, in effect, go into receivership. So that's what we're talking about. It's not, the workers taking over the banks. Maybe we want to do that, but this is the story. You have a bankrupt bank, goes into receivership. The management is thrown out on the street. The stockholders, you say, well, you lost your bet, and we want to keep the bank operating because we don't want the problem for the financial system. But the people who lost their bets, they have to pay the price.
One of the ironies here, just to interject something, is that someone talked before about people's retirement was now in their homes because of the lack of pensions. A lot of people's retirement is also in large institutional pension funds, who were including, as well as hedge funds and others, were the major investors that were buying a lot of this bad paper that had been rated AAA and was -D. And we represent a number of those pension funds, and they are still trying to sort this mess out. And from what Dean said earlier, is absolutely true. You can't even figure out who holds the paper. I mean, it's just quite extraordinary. They just disappear. So
Yeah, no, that's
a lot of money being lost.
That's really unfortunate. A lot of pension funds, yeah, they did. I mean, this again, fallout from the stock bubble, because you had a lot of pension funds suddenly were underfunded when the stock market went through the floor. So they got these geniuses on Wall Street, ran down there and said, oh, we could improve your returns. And they got them into this garbage, So, yeah, it's a real mess. I'm sorry. So the other two questions, how long will it take? It's very hard to say. It's funny. I go around on a lot of panels. I have all these economists, and they say, well, the housing market isn't like the stock market. It adjusts slowly. And I'm going, wait a second. Don't we usually think that thin markets are more volatile than, so you think about that, if you want to buy General Electric stock, there's 20 million people out there, if the price falls 5%, they'll go, well, I'll buy it, On the other hand, my home, how many people, 10 people, 20 people in the world, it's a specific spot, specific type of home. It's a very thin market. So I actually think the adjustment might be fairly quick. Doesn't mean it won't be bad, but I think it might be fairly quick. That's my hope. It's not pretty, though. I mean, part of that story is that, before, a year and a half ago, they were telling people zero money down, that's just fine, borrow 103%, that was happening in places. Now they're saying 20% down. So you go, here in D.C. or California, the median price of a home is $400,000. How many people have $80,000 to plunk down? Even if you already own a home, you don't have any equity in it because the price just fell, so people can't buy a home, so the market is shutting down. So that might be fairly quick. It's not pretty, but it might be quick. Now, the last question, about credit cards, yeah, again, this is one of these things you want to, economists can be surprised by things all the time. So if you look at what happened with credit card debt, it stopped rising, or almost stopped rising in 02, 03, 04, 05. Surprise, surprise, house prices are going up. Why would you borrow on a credit card when you can buy a lower interest rate on your house? So people are doing that. Well, what happens when house prices start falling so you don't have equity in their home? Well, guess what? They go back to borrowing on their credit cards. Now, what happens with a credit card debt? Well, as long as you have equity in your home, you can meet your credit card payment. Once you no longer have equity in your home, there's going to be a lot more defaults on credit cards. So you get all these people going, who could have imagined? So, yeah, it's going to be very bad news. They're going to take a really big hit. What we care about is a lot of people that, were making ends meet by borrowing on their house as long as they had equity. Then they went to their credit cards. They're at the end of the line. It's, this is a really, really bad story.
Eleanor, you can go to the back of the line if you want and then start over again.
My issue goes to the economist, the expert economist Dean Baker from SIPR. And the thing is, I come originally from Europe. And I speak for a lot of Europeans having resided here in the United States for an X number of years or decades. And we are very unpleased about the devalued US dollar. It used to be the strengthened US currency, and it had a shining light in the whole world. And now it's going to be devalued. Yesterday I looked up the index, and I was shocked, 1.58 almost on euros you have to spend. It makes us very unhappy. And I just heard yesterday from the Federal Reserve that the Federal Reserve or the U.S. government is very much interested in a strengthened U.S. dollar. What is your stand on that now? Because you like to see a devalued U.S. dollar.
Expecting another 100 basis points cut tomorrow.
Really? I had not seen that.
Who invited the Europeans to this meeting?
No, you know, the Europeans, I don't know why. Europeans seem to have a propensity, they really want to lose money investing in the U.S. I don't quite understand why. I mean, you know, it happened, you know, you go back to the 19th century, they invested in canals in the 1830s, they lost their shirt, and railroads in the 50s, they lost their shirt. You know, you had big German companies, well, Daimler-Benz spent God knows how much to buy Chrysler, and they lost their shirt, you know. Deutsche Telekom spent, I think, $40 billion to buy up this startup wireless company, VoiceStream. You know, they lost their. I don't quite understand why
How
they're
many
so
shirts
keen to
did
do
they
that.
have?
They're out of there, you know. But you know, but seriously, the dollar has been hugely overvalued. The measure of the overvaluation is simply our trade deficit. You know, we had a huge trade deficit. The adjustment for the trade deficit is a falling dollar. Now, what I should say is that it probably has fallen as far as need be, and maybe even too much against the euro. What really has to adjust is the dollar against the Asian currencies, most importantly the Chinese currency. That's got to come. And, you know, this thing that, you know, again, this stupid situation, I don't like China bashing. We don't have to beat up China, but we do have to get the dollar down against the Chinese currency. And, you know, you always get this story where, you know, we get, you know, different Treasury secretaries run down there and they beg and plead and say, oh, we urge them. We can, you know, they could set an exchange rate against the dollar. We could set an exchange rate against the yuan. You know, we can lower the value of the dollar against their currency. Hopefully we wouldn't get in a currency war. If we did, they would lose. But, you know, if they ever thought we were actually serious about bringing the value of the dollar down, we would negotiate a way to get it down. So I hope that's done sooner. It would help us. It would help Europe. But, you know, the fact that the dollar's fallen against the euro, that's a permanent feature. I mean, I don't know that it might not go back up to 1.5 to, you know, dollars to a euro, but it's not going. We aren't going to go back to, you know, 1.2 or 1.0. The dollar was hugely overvalued, and it had to come down.
We've got 5 more minutes for questions. Go ahead, sir.
Okay, thanks. I'm Mike Foley. I'm a state representative from Ohio, from Cleveland. And we've seen, I think we've got, I don't know, we're averaging 20,000 foreclosures just in our county. We have about 80,000 in the state, 80 to 90,000 in the state now. And one of the kind of the corollary or kind of back-end problems we're seeing in Ohio, and I'm curious if it's happening in other states, is that after the foreclosure happens, 99.9% of the time, the banks or the mortgage company that does the foreclosure gets the property back after the judicial sale or the sheriff's sale in Ohio. And they're getting the deeds to these properties, but they're not filing them with the recorder's office, so no one knows who to contact in order to, you know, when the property's fallen down, or who to send the tax bills to, or to send the code violations after, or angry neighbors who want to find out, you know, why is the home down the street not boarded up and properly maintained. I'm just curious if that's, you know, one is, you know, it's less money they have to spend, put out on maintaining the property that they own. But I'm also curious if that's going on in other states, I guess, and if you've heard about this as a kind of corollary problem for foreclosure.
Lisa?
The short answer is yes, it's going on in other states. Technically, we're told banks don't want to hold on to foreclosure properties. I'm not so sure about that, but I'm going to keep those thoughts to myself for the moment. You know, I just have a view that might be a little different because we assume that banks only want to be banks, and we've learned that Walmart doesn't want to just be Walmart, so I wouldn't necessarily assume that at somewhere down the road you don't see something else occur. But in answer to your question, yes, you're seeing banks who are struggling to maintain these properties. They don't have the money on the books to do that. And no, they're not filing the documents that they need to with the local and state regulatory tax agencies. So I think at a state level, we need to be addressing legislation that address responsibility and accountability from lenders, just so that states can secure the revenues they need from those lenders.
Yeah, I've heard of cases where the banks don't even carry through with the foreclosure. You know, someone's basically left the home because they've been threatened, but they don't ever actually file the papers because they don't have anything to do with the property. They don't, you know, so they don't keep it up. You can pass laws, and I think a number of municipalities have, where they require upkeep, and they say if the owner, you know, the bank doesn't do the upkeep, they will do it and send them the bill. You know, and that's, to my mind, totally appropriate.
Well, that's one of the things we're trying to do in Ohio is just make sure that those documents get filed so we know who to go after for the code violations. So, thanks.
My name's Denise Boyer, and I'm not a state representative, and I'm certainly not an economist because I find it fascinating but extremely confusing. So I think my issue really is about a transparency issue. And it's kind of to build on what you were saying about the nationalization of banks, but first thing is, in transparency on this Bear Stearns issue, what happened, the thing that's very disconcerting to me is, as a personal consumer, I would have loved to have bought that stock at $3 a share, and I would have given them back 50% more on the premium. And I think that that's a big issue, is because these things are made, the deals are made behind closed doors without any input from certainly even a progressive. We're talking about a Democratic Congress, Democratic Senate, without any input from leadership as we have it, let alone a progressive agenda. And so I think that that's the first thing, is transparency. How do we mandate transparency when it comes to the socialization of liabilities for these banks? Because the one thing that I know are banks that are really good at making money. And they're going to make money. And why didn't we insist that if we're going to assume the liability, we don't have to go and nationalize it, but why didn't we negotiate a thing where we've got 1% of the equity if JP Morgan does make money down the road? I mean, I think these are really basic things that, as an average person, I ask myself these questions. And why wasn't I given the opportunity to buy it on the market for $3 a share? I thought it was $30 a share on Friday. I was tempted to buy it then. Thank God I didn't. Thank God I'm that stupid. But how do we force transparency on these issues? That the federal government is involved in the insuring and the bailout, and there's going to be more of them on these issues. How do we force that?
There'll be shareholder derivative cases brought now, which are cases, technically, goes back to the old common law notion of waste, that if you're holding someone else's property in trust and you violate that trust, you violate your fiduciary responsibility and you destroy the property, you can then be sued.
But that's after the fact, Al, right?
No, but Bear Stearns technically belongs to its shareholders, or did anyway. And there'll be lawsuits brought now in the name of the corporation against the directors for destroying the corporation by the shareholders. The derivative cases brought in state court. The ideal thing in such cases is that some progressive union or pension fund or group of shareholders run those lawsuits, because you can actually get quite a bit out of those lawsuits in terms of change, but frequently they settle out just over dollars.
I think your question is, how did it happen? I mean, how did JP Morgan Chase, a big bank, have more concentration of capital? I think that's her question. How did this whole thing happen?
The transparency issue.
They ran out of money, is from what I understand.
Well, it's all behind closed doors, but why was JP Morgan given the chance to buy it at $2 a share, saying, I'm going to take all the assets, and the government, the Federal Reserve, was stupid enough to say, we will insure $30 billion of liabilities without any chance on the upside?
No,
It's ridiculous.
That's exactly the questions we have to be raising. I mean, they're sort of calling the shots, and again, it's a classic thing, like, you know, we're the experts, don't bother us, and, you know, they always do this, and the Fed should be answerable to the public, it should be answerable to Congress.
Who are they? I think Congress is the key. I mean, and here we sit with a Democratic Congress,
they're intimidated
a House
by them.
and a Senate, for God's sake, and who gets elected president is going to be irrelevant if we can't, even with a democratically controlled Congress, ask these hard questions. And I'd like to see some of you guys who are way smarter than me on the progressive side take some of these things to Congress leadership. leadership and say, come on.
It's really, but just so you understand, it is really, really hard. They come there, they have teams of economists, all of whom know tons of jargon, and they have the members of Congress totally intimidated. And furthermore, they have the media totally intimidated. So the member of Congress who has the courage to stand up and question Bernanke or Greenspan, whoever it might be, and say, what are you doing here? What's going on? Well, you're messing in monetary policy. You're not supposed to do that. When absolutely they're supposed to do that.
Right.
We don't want the micromanaging. I don't want, my representative, telling the Fed, do this, do that, do that, do that. But we want the people at the Fed answerable to members of Congress because they are supposed to be acting in our interest. They aren't supposed to be acting in the interest of Wall Street. But I don't know how many people I have just laugh and say, well, they can't do that. That would get them nuts on Wall Street.
Yeah, I'd love to just see,
And just a reminder that, it isn't just the Republicans. I mean, the senator from Wall Street, Chuck Schumer, chairs the
I mean, I
critical
understand,
committee in
like,
the
that
Senate,
was
so.
my point, and the fact that we have 25 co-sponsors, for God's sake,
Well-
on things that protect homeowners, that's ridiculous.
Let me say this. I absolutely agree with what Dean is saying. That said, members of Congress do what they can do based on the support they get from people in this room.
That becomes the political
That-
reality.
right. Because I know what it's like to be in a member's office, having grown up in members' offices and worked in members' offices, and at the end of the day, it's the number of constituents that call. It's the number of constituents that write. It's the number of constituents that walk in the door in the district office and make this an issue every day. However you have to do it in your home state, in that House member and that Senate member's district, they need to be visible, because when CRL and other consumer groups are going to the Hill, one of the first things that we hear is, we're not hearing this at home from the district.
We have time for one more question. What they're
Thank
saying
you.
now in California
Thank you.
is out of the hot tubs back to the streets. So, go ahead.
Just quickly, if the housing bubble began in '95, who were the appropriate regulators at the state and federal level, and the rating agencies, and what should they have been doing, and when should they have been doing it?
Well, there was so much garbage going on. I mean, we just touched on it, so you had a lot of regulators in principle who could have had a hand in this. But Alan Greenspan is villain number one in this story. I mean, he was sitting there at the Fed, and he was sitting there in both the regulatory side and controlling monetary policy more generally. There's this idea, and here again, getting back to that last question, we have to make it very clear, both for our members of Congress, but the media, this is a teachable moment. We got to apply baseball bats here. The job of the Fed has to be to attack financial bubbles, asset bubbles, the stock bubble, the housing bubble. They have this attitude that they just think that, that's just like the weather. It rains and you get out your umbrella. Nothing you can do about it. You go, no, I'm sorry. You're sitting there scared to death that the rate of inflation is going to go up 0.5 percentage point. That's nothing. You're seeing millions of people lose their life savings because there was a bubble in the housing market and they got screwed by it. Same thing with the stock bubble. Not quite as bad a story, but same sort of thing. So Alan Greenspan is front and center. You got to attack bubbles. He thought they were cute. Now, the other part of that, the regulatory side, this was not a secret. You had millions of people getting these predatory loans. This was not a secret. I had people sending me emails about, their brother's a mortgage broker, and they have people coming in and they're told to, lie for them so they can get mortgages that they wouldn't qualify for, to put that, this was going on a massive basis. Greenspan, well, we know he knew about it because one of the other governors of the Federal Reserve Board, Ned Gramlich, was my professor in grad school. He was telling him, and Greenspan said, I'm not interested. Greenspan is villain number one. Now, there are any number of other people. There's other regulatory agencies. There's huge overlaps in jurisdiction between regulatory agencies at the state and federal level, different regulatory agencies. There were any number of other people who could have stood up and said, wait a second, this is nuts, we got to crack down. Some of those people did. They didn't get very far. But Greenspan is really villain number one in this story.
Thank you all for coming. Appreciate it.